The largest asset manager on Earth is actively building on this network. BlackRock is already using it to tokenize real-world assets. Stripe, the payments giant, is routing real financial infrastructure through it as well. The actual usage numbers are massive. This chain has processed over $2.5 trillion in stablecoin volume. Yet, if you look at the native token today, you'll see a price sitting at exactly 9 cents. Retail sentiment is currently paralyzed in extreme fear territory. So we have a massive disconnect. The most heavily adopted piece of institutional infrastructure in crypto is currently trading at a 97% discount. We need to figure out if this is a dying chain or a severe mispricing in the current market. At its core, Polygon is a Layer 2 network. That means it sits on top of Ethereum, bundling transactions together to make them significantly faster and cheaper to execute. You probably know its original native token, MATIC. They recently phased that kicker off completely in a major network upgrade, converting the entire supply into a new token called POL. This rebrand is tied to a new architecture called the AggLayer. Instead of isolated blockchains fighting for liquidity, the AggLayer connects them into a unified settlement layer. Moving assets between networks feels immediate, without clunky bridges or multiple wallets. The shift from MATIC to POL is a complete engine rebuild. Polygon is trying to capture and route the volume of the entire Layer 2 market through one single hub. But there is a heavy drag on the token's price. POL has a circulating supply of 10.4 billion tokens, with a 2% annual emission rate generating constant sell pressure. To offset this, the network destroys tokens through fees. Right now, roughly 1 million POL is burned every single day. There is also a scheduled event in early 2026, where a massive 100 million tokens will be permanently burned. Right now, the inflation is winning. Since hitting its peak of $2.91 in December 2021, the asset has suffered a punishing 97% collapse. The technical structure is resting on a knife edge. The 9-cent mark is fragile, and the absolute critical support level is 8 cents. If buyers don't defend that line, the chart completely breaks down. To the upside, the path is clear. Pushing back through 15 cents with strong volume is the trigger required to flip the broader market sentiment from fear back to neutral. That leaves us with a strictly mathematical problem. Until network activity surges high enough that the daily fee burns actually consume more tokens than the 2% inflation creates, price action will stay locked in a dangerous technical battleground. To force that kind of network activity, the developers are executing the Gigagas roadmap. The engineering target here is to push network capacity to 100,000 transactions per second. To put that in perspective, hitting that speed would make Polygon capable of processing significantly more data than the global Visa credit card network. They need this throughput because they are fighting for market share against other highly active Layer 2 chains like Base, Arbitrum, and Optimism. But Polygon holds a distinct advantage. Elite traditional finance players like Apollo are already building on their foundation. You have countless new networks launching with incredible hype, but zero users. Polygon already has the real on-chain volume and the traditional finance partnerships secured. Which leads us to our verdict. POL belongs firmly on your core watch list. The underlying tech works at an enterprise scale, the volume is verified, and the token is severely lagging the fundamentals. If you decide to add exposure, you can easily pick up POL on major regulated exchanges in the US, like Coinbase. For international users, the liquidity is deepest on Binance. You can also trade for it directly on Polygon's native decentralized exchange, QuickSwap. Drop your price targets for POL in the comments below. Let me know if you think that 8-cent floor holds. And remember to like this video and subscribe for more deep dives. Keep in mind, this isn't financial advice. But historically, when billions of dollars in real institutional utility are actively flowing through a network, that fundamental value tends to outlast temporary retail fear.